Premium Brands Holdings Corporation, PBH on the TSX, trades around $104.35, $4.65 billion market cap. What does the company do? They're focused on acquiring and building value-added food businesses and brands that benefit from being part of their ecosystem, essentially. The platforms and brands are active in the Canadian and U.S. retail and club for food services channels. Let's look at the company's second quarter results. Record revenues in the quarter, but just up 7.3% to $1.63 billion compared to the second quarter of 2022. Record second quarter EBITDA, adjusted EBITDA was up 16.5% to $152.4 million. But adjusted EBITDA, the margin was up to about 9.3% from 8.6% in the second quarter of the previous year. Second quarter adjusted EPS, however, was down 8% to $1.27 in the period. Want to look at valuations. Trailing EV to EBITDA is in the range of 15.89. Based on its current year's expected adjusted EBITDA, the company trades with a forward-looking EV to EBITDA in the range of 12. Premium Brands has significant leverage with net debt of approximately $2 billion. To put this in perspective, the market cap, like we said, $4.6 billion, and its estimated adjusted EBITDA for the current year is just under $600 million. So on a trailing basis, net debt to EBITDA is in the range of 5.6 or 4.55 on a forward-looking basis. Both are high in terms of leverage ratios for this company. There are those that will adjust out the company's convertible debt and arrive at a figure of roughly 3.6, but the convertible debt is debt, so we're going to keep it in there. Our take, Premium Brands has been a solid Canadian food services consolidator, but as it has acquired more and more businesses, debt has mounted, and in a higher interest rate environment, capital is now more expensive. The cost of carrying that debt is squeezing profitability and will squeeze profitability. Additionally, the company's ability to continue to acquire, to grow, which has been part of its lifeblood, has been impeded. Now, we have liked the business in the past, but the revenue growth rate continues to be slow and slowing, coming in at just 7.3% in the last quarter. And on an adjusted basis, earnings were lower in the period. Valuations are okay, but with a lack of growth or high-level growth, even mid-level growth, the share rebound year to date has the company trading closer to fair value than undervalued at present when I look at it. And that's all
we looked at the company last year. I wrote a report up to Q3 2022, and I noted in that report that they were exceeding their targeted debt they targeted at the time. And I'm guessing this is still the case of 3.5 to 4 times adjusted EBITDA.
Yeah, basically.
So they're still well above it. And so if they're constantly exceeding their target, what good is that target when you're looking at it as a company? Really, it's just they're over leveraged at this time compared to what they want. So what we want as well.
It's a couple evils that are hitting them there. I mean, they obviously interest rates go higher. It's, the more debt they have, even if they have this consistent debt level, if you were paying 4%, now you're paying 8%. I mean, it hasn't been a jump like that, but if you have that type of jump, you're squeezing your profitability. And then they've always been able to have access to relatively, easy capital via debt. It's not as easy to get. It's more expensive. And, if you want to go out now when they may think their share price is undervalued based on EV to EBITDA, for example, it's you're going to be more dilutive at that point. So it's a catch-22 situation they're in. Everything's great in a low rate environment. Now you're kind of paying the piper for the debt you built up over that time. I think there's some great brands in the company, and it's not a horrible business by any means. But will they be able to grow at a rate that'll get them anything close to a premium valuation on Premium Brands? I don't think so at this point.
Yeah, and I just looked like all of their debt's basically variable. So yeah, I just quickly looked.
Mm-hmm. It's squeezing profitability and will continue to. And, they have high input costs. Now, some of the food prices have come down over the course of this year. That could help improve margins. It's something to definitely look at. But, interest costs have not gone down. So they're going up significantly, and debt is high. And they have convertible debt too. Maybe it doesn't get converted, but it is debt that's sitting there. So we're going to factor that into the equation too. And when you do that, they're the debt levels are high.